Welcome to another episode of Profit Unpacked. Today we want to be talking about the Qantas share price and especially the airline industry going into 2020-21. So the Qantas share price has been on a bit of a roller coaster for shareholders over the past year, seeing dropping from opening the year at about $4.86, dropping all the way down to about $3.19 before absolutely rocketing up here to reach about $5.80 a share. It's pretty much sort of moved down and sideways for the time being before hitting sort of another low here at around $4.30. We expect it to sort of hover around here and move sideways for some time until international travel opens up and Australia really starts to get those travel bubbles opening up there. So what does Qantas actually do? So Qantas provides passenger and freight air transportation services in Australia and internationally. It's pretty important to note that it also offers air cargo and express freight services. Qantas operate a fleet of 314 aircraft under the Qantas and Jetstar banners, and it's pretty important to note that the majority of Jetstar routes are on the domestic route. So on the 20th of May 2021, Qantas released an update to the market regarding the repair to their balance sheet and their recovery after COVID ravaged the airline industry. In the update, Qantas highlighted the sustained domestic recovery, which is currently driving strong cash generation. Qantas highlight that they expect the cash flow to be cash flow positive for the second half in 2021, with Jetstar already EBIT positive from April 2021. So that's obviously a really good sign there for Jetstar. However, Jetstar was always expected to recover quicker than the overall group due to the high proportion of domestic routes that Jetstar operate on. So just jumping in here to the first half 2021 results from Qantas, they really point out their balance sheet and their strong balance sheet position. They're looking currently net debt of 6.05. They're saying that that has actually peaked and net debt should now continue to come downwards. And Qantas's recovery plan is actually on track. So it's important to note before COVID, they actually had a $1 billion initiative to reduce costs. And due to COVID, it's kind of actually accelerated that. They've already delivered $600 million in structural cost benefits in FY 2021. And expecting another 200 million by FY22 and at least 1 billion in annual cost improvements from FY 2023 onwards. We're looking at an enhanced competitive position with 70% domestic capacity share and leading premium service and low-cost carriers, leading loyalty program and significant structural changes to the cost base. So it's pretty important to note that Virgin's had a lot of troubles and Australia's pretty much dominated by two massive players, so Qantas and Virgin. We don't think there's any room for a third carrier within Australia. We just don't have the population to support it. We could be proven wrong, but we don't think there's room for a third player in the aviation space in Australia. COVID continues to be a concern. Qantas really flagged the 3-down lockdown from Perth during April cost the group an estimated 15 million EBITDA. And this follows the $29 million impact from the Brisbane lockdown in late March and the Sydney Northern Beaches outbreak that resulted in a massive impact of around $400 million on EBITDA for the record. So it's pretty important to note once COVID is eradicated from Australia, the majority of the population gets vaccinated, we should start seeing Qantas return to profitability slowly. It's not going to happen overnight, but it should happen. Qantas has probably got one of the best balance sheets of any airline in the world. From the fundamentals, you can see here, like just putting that against the first half 2019 and first half 2020, they actually made a profit of $700 million. This is now ballooned into a massive $1 billion loss in the first half. We expect that this is probably the worst it will get, and we're going to start seeing the EPS turn from negative $2.07 and start to follow a similar trajectory back to profitability over the next few quarters, probably expecting profitability back around 2023 or thereabouts, depending on the COVID situation worldwide. Qantas outlined their focus on aim of generating maintainable EPS growth, which should result in total shareholder returns in the top quartile of ASX 100 and a basket of global airlines. So Qantas obviously really targeting their business to deliver top line growth, shareholder returns in the top quarter of ASX 100 companies there. So that's a pretty key KPI for Qantas there. As you can see, revenue and net income haven't been so good. We're expecting FY 2021 to be worse than FY 2020, but from there we should start to see recovery. Community sentiment on Qantas is we're looking at about 43% saying buy, 32% hold. So overly we're a bit bullish on Qantas and looking at an average price increase to $6.13 a share. So our take on Qantas and what we're doing, and it's pretty important to remember this is our opinion and this is a personal blog only, but Qantas operate in what our opinion could be one of the best airline businesses in the world. I think Qantas and their shareholders have likely seen the worst for the time being and have blue skies to look up to, and we think Qantas may have one of the best balance sheets out of the entire airline industry worldwide. Qantas has got a massive $2.4 billion of cash on their balance sheet, and we see significant upside potential in the Qantas share price. We're currently buying on market for around $4.71 a share with a market cap of $8.9 billion. So what else are we currently buying? Check out our research on Appen. We're currently buying Appen. There's a few good things happening there. And we've just jumped on board the initial public offering for Escari. We think it's going to be massive. So be sure to check it out, guys. And as always, do your own research and due diligence.